Good morning. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture. And on behalf of the Center and on behalf of Purdue Extension, I want to welcome you to our webinar this morning focused on Farm Bill choices relative to the 2014 Farm Bill that was passed earlier this year. Joining me this morning are my colleagues, Dr. Mike Boehlje, Distinguished Professor of Agricultural Economics here at Purdue and Extension Economist, and Dr. Michael Langemeier, who is our Associate Director of the Center for Commercial Agriculture and also a Professor in the Department of Agricultural Economics. We want to spend a few minutes with you talking about the choices that you're facing and how this bill is structured. But before we do, I want to talk a little bit about how you might email your personal questions to us during the course of the webinar. If you've got a question at any point during the webinar, simply send it to my email address here at Purdue, jmintert@purdue.edu, and we'll be monitoring those emails during the course of the webinar, and we'll try and address those questions during the webinar today. If we don't have time to do it on the webinar itself, we'll respond to you individually by way of email later in the day. So if you have a question, go ahead and pose it. Mike, let's talk a little bit about this Farm Bill because it really is quite a bit different than Farm Bills we've had in the past.
Well, Jim, not only is it different than it is, but it's actually kind of interesting just a little bit on kind of how we got there and how important it is. There was quite a debate about whether, in fact, we even needed a new farm program, and we needed to get rid of, many people said, these payments that are made that didn't depend at all on your production, deficiency pay, et cetera. So we needed a kind of direct payments. We didn't need those anymore, and we didn't need any farm program because incomes were very good, et cetera. Well, Congress said, whoa, wait a minute, maybe we shouldn't rely exclusively on crop insurance, maybe we need to put some kind of a little better safety net in place just in case. And, you know, thank goodness they did. I mean, when this was passed, there was not an anticipation that it would actually trigger for 2014. You know, it was kind of something out there with 15, 16, 17, maybe we're going to need something, right? So it's a shallow loss program. It's a program that basically tries to kind of protect in case prices come down a little bit but don't crash. The idea or the idea that either we have a crash in prices or we have really low yields, that's what the crop insurance program, the deeper losses is what the crop insurance program has always had a focus on. And so this is kind of a top up or a protection for the more shallow losses that farmers might be facing. And that's a really important thing because one does not sign up for this program and say, okay, now I don't need crop insurance, right? So we really do need to make sure that we make both crop insurance decisions and make smart decisions there, which Michael is going to talk about here in a little bit, as well as making smart decisions on where we're going to go in terms of the farm program. And these decisions are more complex, and so that's another thing that's different about this program. This program is more complicated, at least in the details. If you get in the weeds, you can get kind of mired pretty quickly in some details. But one of the things which we're going to talk about here is that maybe it's not quite as complicated as we think. I mean, it's complicated, but maybe there is some what we'd like to call a dominant strategy. Maybe there is one or option that might be preferred for most situations than another, and we're going to talk about that in more detail. But it is important to do the analysis for your own farm. So every farm has a base, every farm has acreage, has yield, has all this information, and there are now tools available which we'll talk about, so we do need to get into it at the individual farm level rather than saying, well, my neighbor signed up for that program, therefore that's the program that I'm going to choose. It's not one where you mimic what the person down the road does necessarily, because he may have a unique set of circumstances, or she may have a unique set of circumstances that would choose one that would be very different from what you choose.
So let's talk a little bit about the new programs in this Farm Bill. We've really got three programs we want to focus on today and actually maybe highlight two of them a little bit more than the other third one. The first one's called agricultural risk coverage at the county level. Then we have price loss coverage, which actually most closely resembles some previous farm bills. And then the third one is the agricultural risk coverage at the individual farm level. And you have to make a choice for each FSA farm number that you operate. And so for most of the people watching this program, that's probably going to mean that they're going to make more than one set of decisions because they're probably farming more than one FSA farm number.
So that does kind of complicate in that you can have mixed programs. So you don't have to sign up for a program and have it apply to all of your properties you're operating, right? You could have it one for this particular FSA base and a different choice for an alternative.
Yeah, that's exactly right. And so that does complicate things a little bit. And it does provide some opportunities maybe to make some choices that are better suited to an individual farm that you operate. So that's something to think about as we move ahead here. So the two that we're going to focus the most heavily on today, because we think they fit most people in the Corn Belt, perhaps better than the third choice, are the agriculture risk coverage at the county level and the price loss coverage program. The agriculture risk coverage at the individual farm level, we will talk about a little bit. It's not clear to us that there's going to be very many farms, at least in the Corn Belt, that find that program attractive. And as a result, we're going to spend a little bit less time on that one today. So let's do a little bit of an overview of the process here. Michael, you want to walk us through that a little bit?
Yes, there's 3 key steps that we need to take a look at here. The first step, producer, particularly the landlord, can reallocate base acres and update yields. We're not going to focus too much of our discussion on this. It's really fairly simple. I'll get into the base acre discussion here in a little bit, but the update base yields, you're going to compare your old base yields, which came out of the 96 Farm Bill, the 2001 Farm Bill, with a more recent history in terms of your yields. And so that's going to be fairly straightforward on whether you need to update yields or not. Secondly, once the base acres and yields are set, the election of PLC or ARC takes place on each farm, and we also can make this decision by crop. Finally, the third step, once this election has been completed, enrollment takes place annually on each farm. And so you're going to have an election coming up this spring, and then you're going to have an enrollment which takes place each year.
You said it takes place this spring, Michael, but we need to recognize 2 things. Number one, we are signing up for a 5-year period of time, right? So it's not an annual sign up, it's a 5-year commitment. And it's going to be retroactively applied to the 2014 crop in general, even though we actually will be signing the papers in 2015.
Yes.
Yep, okay.
So Michael made it pretty straightforward with respect to the yield update. If yields are higher, go ahead and update. What about base acreage, Mike? We're right in the middle of that decision-making process right now. Should we update our base acreage or not?
Yeah, well, I think it's really important to update your base acreage, and we're going to show you some numbers here a little bit that will reinforce this idea. But the numbers suggest that we do have the opportunity for a little better payments, it appears, on the corn base acres than we do on the soybean base acres, and even a little bit better on the wheat base acres. And so if we have actually been planting more corn recently than the base that we've had, we probably do want to update and get more corn into that, because that's going to increase the total amount of money that we're going to be receiving out of this program. So updating can be really, really important. It's not just well, I've got that all taken care of and we don't have to do that. If you have made major changes in how you have been farming your operation since the previous farm program, you ought to do that. And it's also important to recognize that that this does not influence how you're going to farm this property this next year. So this is all history, right? All history that we're worried about in terms of updating these bases. And so you could have a lot more corn, add corn to your base because you've got the history to do that, and then you could plant all soybeans this next year if you wanted to. So it doesn't constrain you or limit you in terms of what you're going to be doing in terms of cropping for the 2015 season.
And so a lot of people in the Corn Belt did shift to planting more corn in recent years because corn was often more profitable.
Right.
So a lot of people are going to have an opportunity to shift some base acres towards corn. And our perspective is that that's probably going to be a good choice for most people throughout the Corn Belt.
Absolutely. Now, but it's also important, I think, and Michael, we were talking about this earlier, actually the estimates right now suggest that corn will probably have the best payment potential, particularly under the ARC program, but wheat actually has a second best payment potential, with soybeans the lowest. Mm-hmm. And so if you also, back to the point, if you've been growing more wheat than you have historically, you probably also want to get more wheat acreage in as well. So it's both corn and wheat that really have the potential here.
Right, and so people perhaps in the Western Corn Belt and especially in the Great Plains might want to look at that pretty closely.
Absolutely.
So Let's talk a little bit about the Ag Risk Coverage County program and walk through some of the details. It's a one-time choice by crop for the 2014-2018 timeframe. Payments occur when the actual crop revenue falls below the revenue guarantee for a crop year. And that guarantee is going to be 86% of what's known as the Ark County benchmark revenue. Coverage is capped at a 10% payment, and that's why it's sometimes referred to as a shallow loss program. So you get your maximum payment when actual county revenue equals 76% of that benchmark revenue. There's no additional coverage if revenue falls below the 76%, and that's going to be a key difference between it and the PLC program later on. So what is that benchmark revenue? It's the Olympic average of county yields and the U.S. marketing year average prices for the preceding 5 crop years. Payment is going to be made on 85% of your base acres, and again, that's going to be a key point relative to one of the other programs, namely the ARC individual program. So that gives you some details with respect to how that works. Let's talk about the ARC individual program. I'll let Michael talk about that one.
Well, all of a sudden here now, I used to get direct payments, and I just they showed up in my account, right? I signed up and they showed up. Now you're telling me, and I didn't have to do much analysis to get those direct payments, right? You've
Correct.
already kind of got me in the weeds a little bit here, but we're going to actually show some spreadsheets in a little bit.
Right.
They're going to actually take and show how we put these numbers together. Is that correct?
Exactly. So we'll show a tool that shows how you could compute those revenues, look at those guarantees, and actually forecast or at least estimate what those payments might be under, in particular, 2 of these programs.
Good, good.
Most farmers in the Corn Belt have revenue protection crop insurance. Of course, revenue protection crop insurance is based on individual yields. And so when they initially look at this agricultural risk coverage, they see there's an ARC County and ARC individual, and they're saying, I want to use my individual yields. There is a problem with doing that, and I want to talk about that on this particular slide, but that option is available. We have the ARC County, which is used as county yields to calculate the ARC benchmark revenue. We also have ARC individual. This also is a one-time irrevocable choice by farm for 2014 to 2018. In this case, however, it's not by crop. ARC individual is a whole farm unit program, and payments occur when actual crop revenue for all program crops, we calculate revenue for all program crops combined on a farm, fall below ARC revenue guarantee for a crop year. And so this calculation is quite different than the ARC County. First of all, it's not based on county yields. Secondly, it's not crop by crop. And so that's some key differences here between ARC County and ARC individual. ARC guarantee is 86% of ARC benchmark revenue. That's very similar to ARC County. Maximum payment equals 10% of ARC benchmark revenue. Again, that's very similar to ARC County. The kicker here, and the spoiler perhaps, is payment in this case is based on 65% of the base acres. Essentially what that means is you'd have to have substantially higher individual yields compared to the county yields in order for this to even come close to being attractive. And so for many farms, the ARC individual is not going to come into play. That does not mean you shouldn't take a look at it. You should take a look at it because the facts on your farm may be such that ARC individual looks attractive. But I definitely would look at ARC County and ARC individual and then fit your facts into the tools we're going to talk about and see if ARC individual is competitive.
Yeah, and I think if you want to come back to why we're going to focus most of our attention today on the ARC County program and the PLC program, it's really tied to that payment made on 65% of the base acres in that ARC individual program. That is the spoiler, as you pointed out, that makes this program relatively unattractive to most farmers in the Corn Belt. And as Michael pointed out, there's going to be some exceptions, but in general, it's not going to be a very attractive program for a lot of people in the heart of the Corn Belt.
So just to remind people, it's 65 versus 85.
Yeah.
That's a big chunk of difference.
Yeah, that's a big penalty for participating in a program that potentially fits your farm better.
Right.
But you're paying a penalty effectively for choosing that program.
Right. And the fact that it's based on a whole farm unit, and so you had to put all that revenue together, that takes away the advantage that corn might have under the ARC County.
Yeah.
And so the yield increase is more than 20% actually if you do the calculations.
Yeah,
it's
right.
closer to 25, 30% higher yields you would need in order to make ARC individual competitive.
Yeah, and that's that was one of the things. I know a number of people in the Corn Belt were thinking initially this might be an attractive program, but when you crunch the numbers, there's going to be a relatively small number of people in the Corn Belt to find this to be attractive from our perspective. So that's going to be a key point. Let's talk about the price loss coverage program, because there will be more people that choose the price loss coverage program. Payments occur under the PLC program if the higher of the U.S. average marketing year price for the crop year or the crop loan rate falls below the crop's reference price. And your first question right there is, what is the crop reference price? Well, those were actually established and published in the Farm Bill itself. So the corn reference price for 2014 through 2018 is $3.70 a bushel. The soybean reference price is going to be $8.40, and the wheat reference price $5.50. Payment, again, made on 85% of the base acres, and that's one of the reasons why this program is competitive with that Ark County program. Payments are made on the same portion of base acres. And that's regardless of actual plantings in a given year. And Mike, I think that's a point we need to stress, because as you and I and Michael have done meetings around the state and around the Midwest, we've discovered some confusion on that point. I think there's some people think that actually is tied to plantings. It's not. It's tied to your base acres, and that's based on history.
That's right. That's right.
Jim, I think it's also important to note the relatively low price for soybeans, $8.40. That's quite a bit lower compared to the forecasts. When you look at forecasts for corn and wheat, it looks like prices could be below those triggers. But certainly soybeans, that's a fairly low price. That's a very important factor when you're looking at these programs and looking at Ark County and PLC, is the fact that this trigger price for soybeans is as low as it is.
That's right, and makes, in general, probably going to make PLC for soybeans unattractive again throughout the Corn Belt.
You know, again, I'm not a skeptic here, but now I got 3 relatively complicated programs, so I'm just not going to sign up. I'm just not going to go there. I'm just not going to sign up for this thing. It's just too complicated to analyze. But the government won't let me do that, right? Well, I mean, they've said that if you don't sign up, guess what? We're going to sign you up for one. And which one are they going to sign you up for?
They're going to sign. Yeah, they're going to sign us up for PLC. And you know, I don't think a lot of farmers that are viewing this program are going to do that, obviously. But there are some landlords in particular that might be in that situation.
Exactly.
And if you're working with a landlord that's in that situation, you need to point out to them that that's not a good idea.
Right.
You can default to the PLC program. That's how this works. But if you do that, you pay a penalty, and that is that you give up any potential 2014 payment.
Yeah, so you may be signing up for the program that would give you the least payments generally overall, and at the same time you give up what is probably a pretty decent payment, at least on the corn, in the 2014 year.
Yeah,
so it's quite a penalty.
So the default choice is not a good choice.
Yeah.
You need to go ahead and actually make your choice even if you choose the PLC program.
Yep. Yep. So I think what we're really saying is that, and where we want to go is to get in a deeper dive in terms of the programs that probably have the potential to be the dominant ones, the ones that look like they have the most potential, and then think of the alternative programs maybe as challengers, but start out with the one that looks like it has the most potential. And I think most people there do work with Ark County and then start looking at what does PLC do relative to Ark County, but they kind of start with an Ark County base. And then we maybe even throw in a little bit on the individual as well. But that's kind of probably the strategy that we ought to use to kind of do this analysis.
Yeah, based on the analysis the 3 of us and others at Purdue have done, it sure looks to us like you probably want to start with Ark County, compare results under that program to the PLC program, and in some cases the Ark individual program. Right. And as Michael said earlier, it's relatively straightforward to make those comparisons, so it's not that difficult. Right. It's worth taking a look at. But the 2 that most people are going to want to spend the most time on are Ark County and the PLC program, and that's where we would suggest you start off. So let's talk about the big differences between the Ark and the PLC programs. Both of the Ark programs, both the county and the individual program, are what we're characterizing as shallow loss programs. That means that you can receive a payment more quickly under those programs, but the payments are capped, and they're capped at 10% of that benchmark revenue figure. That means if we have a deeper dive, a deeper decline, a sharper decline in prices and revenues, we're going to hit that cap perhaps fairly quickly.
And that's why, just to reinforce, why you can't use this as the only risk management strategy. You better take advantage of the government, of the crop insurance program as well, or you're going to find out that, whoops, after the 10%, now I'm exposed again.
Good point, and that's exactly right. You want to combine it with other risk management strategies, and crop insurance is really only one of those strategies,
That's right. No, that's absolutely right.
That's not the only one. I think, and you need to think about some price risk management strategies as well. The PLC program is designed to protect against larger revenue declines, but provides no shallow loss protection, and in that sense is a little bit more comparable to what we've experienced in prior farm programs. So from our perspective, PLC is attractive primarily if you are very bearish or very negative on crop prices in the 2016 to 2018 framework.
So let's make sure we understand what we're saying here. We're not worried about only predicting prices now to make a decision on this for 2015. We're worried about trying to think about what prices are going to happen in 16, 17, and 18. Are you going to be willing to do that, Jim, is to predict those prices out there? You're an outlook person. Tell me, what's going to happen in 18 on prices?
So the reality is there's a lot of variability in what could happen in 16, 17, and 18, and truthfully, even in 15, but not with respect to this program so much. But I think the key is the tools that we're going to talk about give you the opportunity to evaluate various scenarios. And that's really what we're suggesting, is that you think about how these programs would work on your farm in a fairly optimistic price scenario, maybe kind of a middle-of-the-road price scenario, and then also look at it in the event that we have a very negative or very bearish price scenario. These tools will make it relatively easy to do that, and I think it's important to think about all three of those options because we simply don't know what's going to happen in 16, 17, and 18.
But we have the capacity to do a lot what if types of things to get some sense of the downside exposure, depending upon and which one we ought to have if we really think that downside is pretty deep.
And from a management perspective, that's exactly what we're advocating.
And when we're looking at these prices, we have to remember these are national prices, they're marketing year averages, and so these aren't harvest prices or anything like that. They're not tied to the crop insurance prices, and so these are marketing year average prices. And so for 14, we're looking at September 2014 all the way through August 2015. And so I think it's very important to keep that in mind when you're plugging prices into these tools.
Yeah, that's a good point, Michael. These are the same prices that if you follow things like USDA's World Ag Supply Demand Estimates, these are the prices they publish on those reports. So you might have seen these prices in the past and have people reference them. But they are not, as Michael pointed out, the prices we use to compute, for example, crop insurance returns or even cash prices locally. So let's do some comparisons here. And what I'm going to do right now is actually just draw a chart for you. I'm going to try and simulate doing this at the blackboard so you can maybe understand how this is working a little bit. So we're going to draw a chart that has on the vertical axis something that we're going to call the policy inclusive effective price, which is a term that only an economist could love.
Right.
So what is a policy inclusive effective price? Well, what that really is the revenue you receive from the marketplace plus the revenue you would receive from whichever government program you choose to participate in, whether it be, in this case, the ARC County or the PLC program. And then we've incorporated that or driven that back to a per bushel basis so that you can make a comparison across these programs. On the horizontal axis, we've labeled that the marketing year average price that Michael was just referencing. And so those are the prices, just to give you some scenarios, some possibilities to think about, and think about what your policy inclusive effective price might be on your farm if the marketing year average turns out to be one of those numbers that I've got labeled on the screen. And I've got pretty much the range of possibilities there. On the low end, 250, which is very, very bearish, and on the high end, 550, which is pretty bullish. So the first line I'm going to draw is a line that says what would happen if you didn't participate in any of these programs. And that really is just a 45-degree line. It simply is a one-to-one relationship. As the marketing year average price, in this case, declines below 550, what happens to your policy inclusive effective price? It declines dime for dime, dollar for dollar, with declines in that marketing year average price. So that's the blue line, the no policy option, the no government program option. The second one I'm going to draw is the policy inclusive line, policy inclusive effective price line, if you participate in the ARC County program. That's the shallow loss program. And notice that that red line laid right on top of the blue line for a while, and then it diverged or had an inflection point to the left when we hit that 86% of the county benchmark revenue. And at that point, the ARC county program starts kicking in, starts providing a subsidy to you, and then it continues to increase the size of that subsidy until we hit 76% of that county benchmark, and that's the second inflection in that red line. And from that point on, it's simply parallel to the blue line, meaning from once prices and revenues drop below that 76% of the benchmark revenue, you continue to suffer any additional declines in the marketplace in your policy inclusive effective price. So
Right.
that's the shallow loss component, and that's that portion of the red line that is got kind of flat to it and has those two inflection points. That's where you get some benefit from the ARC county program. The third line I'm going to draw is the PLC effective price line. And again, it lays right on top of that blue line and continues down past the inflection point of that ARC county effective line. And the reason it does that is because that reference price for corn is quite a bit lower than the point where that ARC county program starts to kick in. Remember, we said earlier that the PLC program is more of a deep loss program. It's not a shallow loss program. It does kick in when we see a sharper decline in prices and revenues. And if you look at that line, the other distinction between the PLC program and the ARC county program is once the PLC program starts kicking in, there is no cap on the payments.
Right.
And hence that line continues to, instead of becoming parallel to the blue line like the ARC county line did earlier, it continues to slope off to the left there, and reflecting the fact that as prices drop below that reference price, the payments to you from the government continue to increase from USDA to your farm operation.
So if I look at that chart and just kind of get some visual impressions there, if I were really pretty bearish on what I thought prices were going to be out there, I'd see that green line there, what, about 310 or something about that? 320 is exceeding the red line, which would suggest that, you know, that would be the program that I ought to think seriously about considering if I was really bearish on those prices. Is that correct?
That's about right, Mike. If you look at it closely, it turns out that the point where that green line is going to cross the red line is going to vary a little bit as we move around the country, as we move around counties, because of the yield numbers and the price numbers, or actually the yield numbers. And then secondly, it's going to vary a little bit year by year, and I've labeled that 2014, so that's actually pretty effective for 2014 and 2015. That's going to shift a little bit for 2016, 17, and 18, depending on how things turn out. But you've got the basic idea right, and so for most people in the Corn Belt, and we did some calculations earlier, and Mike was indicating a range of prices, that's about right. In 2014, depending on the county you're in, somewhere between maybe 305 and about 315. Is where those two lines are going to cross, depending on your location as you move around quite a bit of the Corn Belt.
I want to focus on another range there, going from about 310 to 370. Notice there, for that range, that even though PLC is paying, you're in the money in terms of PLC, ARC is better in that range. And so that's a more likely range to occur. And so I want to make sure everybody understands that from this graph.
Yeah. So the point where the red line and the green line cross, from that point to the left is where the PLC program would provide you more government revenue than the ARC County program. At points to the right of that, the ARC County program would provide you more revenue. And Michael's right, that's probably the more likely scenario for us to look at going forward. Let's look at the exact same kind of graph for soybeans. And so we're going to draw that policy inclusive price on the vertical axis, marketing your average prices on the horizontal axis. In this case, I've got them going from between $6 and $12 a bushel, so a very wide range. Same story with respect to no participation in the program. You simply suffer any declines in prices that occur, penny for penny, dime for dime, dollar for dollar. The ARC County program kicks in. The geometry on this graph is identical to the previous graph, so the shape is the exact same thing we saw before. What's different is the points where the crossovers occur. And again, looking at those prices, and I think this is the point that maybe you made a little bit earlier, Michael, look where that green line crosses the red line for soybeans. What's that price level is down? Well, it starts with a 7,
Very
right?
low, yeah.
Right.
It starts with a 7.
Right.
So it's pretty darn low. And I think the question is, is it likely that we would see soybean prices over the next several years collapse to that level? Most of the forecasts that are out there suggest that's not a very likely scenario. And again, looking at your point again, Michael, to the right, even when the PLC program is kicking in and that reference price for soybeans again was how much?
$8.40?
$8.40. So it starts kicking in at $8.40, but until you get
to about $7, our county still is better.
Yeah. So that's the key point to think about there.
Right.
And we're going to show you how you can compute those crossover points, and using the Farm Bill tool. So I think that's very useful thing to do. But keep the shape of these two graphs in mind as we move on.
But we're going to do
here.
that for corn, Jim. And so I do think it's important to point out for soybeans, if you look at the latest FAPRI projections, which are in November, if you look at 2014, I believe the price was $10. For 15 and 16, it was below $10. But I think the low end on that forecast was $9.10.
Right.
That's still substantially above the $8.40.
The trigger points.
And
That's
so
right.
we're quite a ways from that $8.40. And so I want to reiterate that again, that's pretty important to keep in mind. And that's one of the reasons why PLC does not look very good for soybeans.
Yeah.
We're not going to go through an example for soybeans today using one of the spreadsheet tools, but I did want to make that point. That soybeans and PLC is not a good match right now.
And the key is to not just look at the reference price, because even if even if the marketing year average drops below the reference price,
it's got to go way to $7 before.
It's got to get down, not all the
Very
way to
good
7,
point.
but into the 7s.
Close.
Before it becomes better than the Art County program. And so we'll show that here in a second. So I want to talk just a little bit, though. If you do choose the PLC program, there's an additional option that relates to crop insurance. And let's talk about that for just a minute.
Yes, as Jim says, if you do choose the PLC option, you can also enroll in the supplementary recovery option. Essentially what this is additional county level crop insurance. Coverage level cannot exceed the difference between 86% and the coverage level. And so if you have 80% coverage level, revenue protection coverage level, you'd have 6% protection there, 86% down to 60%. It does have a fairly healthy subsidy rate of 65%. And again, it's not available if you're an ARC. I want to make 2 points related to the SCO, and that's the main reason why we've included this slide. First of all, this is not a game changer. If you're looking at PLC versus ARC, your potential payouts from SCO, at least in the Corn Belt, in Indiana in particular, your potential payouts are going to be fairly small. Yeah, they're going to be higher than your premiums, your expected premiums, but not by very much.
So when you say small, I mean
less than $5
less
an
than
acre.
$5, right?
Less
In
than
fact,
$5
some of the numbers that you did earlier, it was even only
closer,
a buck.
Yeah,
right?
closer to $2.
Close to $2.
$2 an acre. And so this is not going to be a game changer when you're looking at PLC versus ARC. Another point I want to make here is I would not necessarily reduce my coverage on crop insurance if I choose the PLC option. You don't have to do that, and I wouldn't necessarily do that. If you had 80% revenue protection policy in the past, I would strongly consider looking at 80% again, and don't drop your coverage just because you had this SCO is available. The main reason I say that is we've got to remember that our projected prices next spring are already going to be lower than what they have been recently, and so your revenue guarantee on those crop insurance policies are already going to be lower.
Right.
And so if you drop your coverage, your revenue guarantee is going to drop even further.
Right.
And so I would really try to think of these things as there is some interaction between these government programs and crop insurance, but I would not rely on these government programs and say, well, I can reduce my crop insurance coverage because now I have this shallow loss programs. I wouldn't necessarily do that.
Yeah.
And I think the other key is if you do choose PLC, you'll probably want to look very closely at the possibility of buying the SCO option.
Yes.
It's not going to be, as you point out, not a game changer, but it is a sweetener. It does provide a little bit of incentive, so it does help. And it's largely because the subsidy rate at those high levels of coverage under SCO is higher than it is under traditional crop insurance.
Yes, you get to
really the key.
80%, 85% coverage levels, and the subsidy rates are smaller than they are at the lower coverage levels, and they're certainly smaller than 65%, unless you have enterprise units.
And that's a key point because
Yes.
those enterprise unit subsidy rates are actually higher than
Higher
under
than the
SCO.
65%.
Yeah, so
Yes.
it's something to look at. It's not a slam dunk kind of a thing.
And this is a sweetener, but it doesn't necessarily then make it dominant over the Ark County program because of this sweetener.
That's our analysis. That's exactly right. All right, let's kind of summarize some things, and then we'll take a look at some tools here a little bit. First of all, we've said that we favor reallocating base acreage
Right.
if you can allocate a higher percentage of your crop base to corn.
Right.
Historically, in farm programs, payments under corn have been larger than for the other program crops, and we think that will be true again in the future. So we think reallocating base towards corn makes a lot of sense if you have that opportunity. I guess we need to point out, it's an A-B kind of a choice. You only have two choices here with respect to base acreage. You can keep your current base, or you can reallocate it based on your recent planting history.
Right.
You don't get to choose anything else.
Yeah,
It's A
right.
or B. It's not anything in between. And I've had some folks ask me about that specific question, so that's a point to
And
keep
you
in
also
mind.
can't increase your base acres. That's important to point
No,
out.
your total base acres will remain unchanged. All you can do is reallocate your existing base acres. That's a
Right.
good point.
And at the same time, we've got corn here on the slide, but it also is the case that you ought to at least look at wheat as well and see if you want to, if you've been producing more wheat recently, and do some allocation there. So corn is first to reallocate to, and then wheat. Soybeans, doesn't have the potential in terms of payments. So we ought to
Yeah.
kind of move it into the corn and the wheat space if we can.
Yeah, the three major program crops we here in the Corn Belt, we think that soybeans are the ones that are going to get the smallest potential payments.
Yeah, that's right.
So.
That's right. Well, and particularly for those who might be out in the Great Plains, this wheat allocation issue is really, really important. They may not have that corn issue, but they do have the wheat issue.
That's right. That's right. Compare your updated yields to current program yields and update them if the yields are higher. That's a very straightforward one. And that's true regardless of which program you elect to enroll in. So some people might think, well, maybe it doesn't matter if I'm going, for example, Ark County because those yields won't be used to compute my payments. We recommend updating those yields. You don't get very many chances to update your program yields at the FSA office. You got a chance to do it now. Those might be the yields you have to live with well beyond this
That's
current
right.
farm bill.
That's right.
So if you get that chance, do it.
Right.
I think that's pretty unequivocal.
Yep, absolutely.
And then in terms of evaluating your choices, we recommend starting off and using Ark County as your initial program choice, and then evaluate the other two possibilities, Ark Individual and PLC, as challengers to Ark County. And truthfully, the challenger we think that most people are going to focus most of their attention on and should focus most of their attention on is the PLC program.
Right.
That's the one that for many people is going to be more competitive and potentially more attractive and something they might want to think about doing. So, Michael, let's talk a little bit about the information you need before you start using one of these tools.
If you're looking at an online tool or the FarmDoc Fast Tool spreadsheet, basic information you need: base acres and program yields. Landlords were sent information on base acres and program yields fairly recently, and so you should have that available. Also, planted acres and yields since 2008. That information is needed on the reallocation of base decision. So that's why you need that information. Expected yield in 2014 is important because that's going to impact your payment, your potential payment under Ark County program. You also need projected national average marketing year prices for 2014 to 2018. Don't lose a lot of sleep if you can't come up with these. All the tools typically have price forecasts built in them, particularly the online tools. They have the FAPRE forecast and you have USDA forecast that you can choose from. And also, particularly for the online tools, you need some information on crop insurance program and coverage level.
And back to the pricing again. One of the beauties of these tools generally is that you can say, okay, here, let's, under different forecasts, what if, what if, what if? So you get a sense of how sensitive your decision is to different expectations concerning the future.
And we're going to do that for an example of corn here in a couple minutes.
That's right. That's right.
And that really is the beauty of the tools, and that's how you should use them. It's not a case of plugging my numbers in once and saying that's what I'm going to get.
Yeah.
It really is about thinking about how the future might turn out under various scenarios and thinking about how that would impact your operation and the revenues that you wind up generating. So that's what we're going to do. We're going to show a little example of that in a couple of minutes. Michael, I'll let you walk through. There's a couple of examples here with respect to the University of Illinois tool online.
Yeah, if you look at the Farm Bill Toolbox on the Farm Doc website, there's several different steps you can take here, and this is a very logical sequence. Notice that 2 and 3 are update yields and reallocate base acres. You probably want to think about that before you start comparing Ark County and PLC, because you're going to need that information when you're making the Ark County versus the PLC. That's step 4. Notice there that step 5 is Ark Individual. Again, the main comparison is Ark County and PLC, but you probably shouldn't ignore Ark Individual, particularly if your yields are higher than the county averages. Maybe you have irrigation and the county average is not irrigated and irrigated put together. In that case, you probably should take a look at Ark Individual. Number 6, even though the SEO net payments, premium indemnities minus premiums are going to be relatively small. You should consider that at least in the decision making. And then number 7, once you've carefully looked at Ark County versus PLC, sign up. Don't forget to sign up so you're not defaulted into the PLC and you don't get you skip your 2014 payment.
And I guess we should also point out that as you move through the Illinois website and this Farm Bill Toolbox, they've got videos on there, and you can see one of them listed there, but they've got a lot of help tools on there, so if you're a little confused on a particular step, you can watch one of the videos. Those videos are pretty short. They're usually, I think, in a ballpark of about 5 minutes.
And they also link to an online tool.
Yeah.
That we're going to show you that screenshot next.
Yeah, so they can be pretty helpful, and hopefully we've given you a good flavor for how this might work, but there's going to be some details you might want to watch one of those videos.
Now, we're going to give them some timelines on this a little bit later, right? So give them an idea of when they have to be signed up, when they've got flexibility to sign up and those types of things. So we're going to get to that here in a little bit.
I want to point out a couple things on this screenshot here. This is the online tool developed by Illinois and some other universities. And so I want to talk about a couple components here. Notice there in the bottom center you have the payment yield update, so you can and base acre reallocation, so you can do those quick calculators to see whether you should update payment yields and look at that base acre reallocation. Once you've done that, the next step I would take is look at a sample farm. The sample farm has county level data for most of the counties in the Corn Belt. If there's USDA NASS data available, it'll show you what the potential payouts might be over the 5-year time frame. So take a look at that, and then once you've done that, then you can go to that center box towards the top, the APAS Custom Farm. That lets you put in your own information and look at different choices.
Yeah, and just to back up a little, when Michael's talking about the sample farm, what they've done there is gone in and looked at an individual county basis and identified what a particular average farm size would be and how crops would be allocated or across that farm. So you can look at how this would play out on a fairly typical farm in your county and give you a little bit of a taste of how the tool works. And so it represents an average farm in that county. It doesn't necessarily represent your farm, but it's a good way to start this process.
At least start thinking about your choices. Yeah. And the real advantage of that is it does look at historical crop mix, and so if there was relatively more corn in your county, that'll be reflected in that sample farm. That's important to look out at, to realize. And also the sample farm lets you look at the potential revenue from the government programs, both on the whole farm basis in dollar amount, but also per acre.
Per acre, yep.
Which is very important for a lot of people to be looking at these per acre payments.
That's right.
And I guess one final point, just to reiterate what you said, and that is the payment yield update calculator and the base acre reallocation calculator are very easy to use. I'd recommend using those. It's very simple and very handy. So
very few numbers are needed, and you have your decision.
Yeah, so it's pretty simple. Let's talk a little bit about another tool, and this one is also from the University of Illinois, and it's actually a spreadsheet. It's an Excel spreadsheet that you can download from their site, from the Farm Bill's toolbox, and we find it to be a very effective tool and a very simple tool, one that actually makes some of the scenario comparisons we were talking about earlier pretty easy to analyze, and so we like it a lot.
Yeah, when I'm crunching numbers for a case farm, I typically start here and then maybe go to the online tool if I want some additional information, tying it with crop insurance, for example. But this is very useful. You go to the Farm Doc homepage and you look under Fast Tools and you'll see a Farm Bill spreadsheet. That's what we're illustrating right here. What we're illustrating here is corn for White County. Notice there that we have some county yields and marketing year average prices. You can't input that information because that information is already there. You don't. This is not your individual yields. This is county yields, using these historical county yields to calculate the benchmark yields. It's using historical marketing year average prices to calculate the benchmark prices, and so that's very important to understand. What you have to put in there is forecasted county yields from 2014 to 2018. We've simply put in the trend. These are trend yields for White County. And then you put in your prices. These prices match pretty closely the FAPRI forecast for November. So we're expecting fairly low prices in 14 and 15, and then $4 in 16, 17, and 18. The benchmark yields are listed there. Those are, again, are Olympic average. Prices are also listed there. They're Olympic average. Notice there that for 14 and 15, we have a benchmark price of $5.28. That's a little higher, guys, than the current price. And so we're going to use $5.28 in calculating the ARC guarantee rather than the current price. That really gives ARC County an advantage over PLC to start with, particularly in 14 and 15. We can look at, in this case, with these prices, with these yields, that potential ARC payments are estimated at $77 and $75 for 14 and 15. Very small payment in 2016 for ARC County. PLC is only in the money for 2014. That's the only year when the price is below $370. As long as the price stays above $370 in the remaining years, you would not get a PLC payment. And so this shows, with these prices and with these yields, that ARC County looks very attractive compared to PLC.
Well, not only that, though, but we're not talking about insignificant amounts of money here, right? I
No.
mean, if you sign up for this program, if you make the alternative, or don't sign up at all, or don't have it, or we didn't have this farm bill, any of those options, there's $75 that you wouldn't have for cash flow. Oh, wait a minute, though. I just said for cash flow, because when do I get this money?
For the 14 year, you would not get that money till September, October 2015. You got to wait till the marketing year to end.
So we better not put it in our cash flow for
not
this
for the
next
spring.
year, right?
Yeah.
That's right. That's a really important thing
And also
to
for
understand.
tax planning, that's important to understand. You're not going to get that money until fall of next year.
That's right. And so from a cash flow perspective, we've got to take that into account. It
right.
comes a year after,
Right.
in fact, the marketing year for the crop.
Another real quick point here, when you look at that ARC payment, the actual ARC revenue using the 350 and 380 would actually result in a bigger payment if we didn't have that 10% cap. And so 14 and 15 is at the cap.
Right. Yep.
The difference between the ARC guarantee and the actual revenue is large enough that the 10% cap comes into play.
So let's make a couple of points here, Michael. And the first one I want to make is really a mistake that I made the first time I used the spreadsheet. So if you're going to use the spreadsheet, it will grab data for you. And so just to walk through, everything in yellow, those boxes in yellow, you get to choose. So when I was doing this last night, I picked Indiana. I picked White County, Indiana. I picked the corn crop. In some counties, you have an opportunity to pick irrigated or non-irrigated. In White County, we did not have that opportunity. And then it gives you a default PLC payment yield for that county. This is a number you need to update, right? And the reason you do is, in most cases, your updated yields are going to be higher than the existing yield numbers. And if you don't put the updated number in, it will underestimate any potential payment coming from the PLC program.
Okay.
First time I worked the spreadsheet, I forgot to do that, and I wondered why I wasn't getting a little more of a boost from the PLC side, and it was because I forgot to update the yields. And that makes a significant difference, so that's a key point. The other point is, as you look down towards the bottom there, those prices, it'll pull in some default values. You can type over the top of those, right? Okay. That's a key point. It'll pull a scenario in for you, but you can evaluate any numbers you want there. So, and we'll actually look at some numbers here in a minute, but you can start typing in other numbers. If you think 350 is too high or too low, change it. 380 and $4, you can change those. And there's a use defaults button up at the top of the screen, so you don't have to worry about losing those default values. You can just click that button and it'll bring back the defaults for you. So that's a key point. And then, of course, as Michael was pointing out, what you really want to look at after you crunch your numbers is what are the payments under ARC and then PLC. So now let's look at another scenario, Michael.
Jim put this scenario together, and notice the only difference between this scenario and the previous one is we've changed the corn price in 14 and 15. We've changed it down to around that 310 level. What Jim's tried to illustrate here is you'd have to be down around that 310 level in order for the PLC payments to be similar or the same as the ARC payments. And so it illustrates the point I was making earlier. If you go from 310 to 370, ARC County's going to be better. When you're 310 or below, then PLC is going to have higher payments in 14 and 15 than ARC County. And so this screen clearly illustrates that. And that's the only difference really is those two lower prices. And so again, the what ifs are extremely important with this spreadsheet. They're very easy to do.
Yeah.
Way I usually do this if I'm presenting this to a group or making some calculations for one of my case farms is I go ahead and use like FAPRI forecast first, and then I say, okay, what if prices were lower or prices were higher even? What would be the potential payments? And so very, very useful.
Yeah, and so what we were really doing here was playing some what-if games, and essentially I was trying to force this model to tell me how low would prices have to go until the PLC payment equaled the ARC payment in 2014 and 2015. And it was a little surprising as to how low it had to go.
Yeah,
so that was a pretty informative thing to do. You can do that same thing with soybeans, right? And you can do it with wheat. So those are opportunities that I would encourage you to do. I found that to be very useful.
Again, you're looking at the benchmark prices compared to the marketing year prices. The way these benchmark prices are calculated gives our county a real advantage. You notice there in 14 and 15 we have the Olympic average of 528, and that's because we had several years previously used to calculate the benchmark where prices were pretty high. And so it's quite likely, given the way the ARC County was designed, it's quite likely that we're going to get payments in 14 and 15.
And so that's really important when you're comparing these two, is that it appears that that there's a high probability of getting, and it's not nearly as uncertain for 14 and 15 because a lot of the parameters are already known, right?
Yes.
And so even if we ended up with lower than the prices that FAPRI and others are projecting in 16, 17, 18, which would kick into maybe a PLC at that point being preferred, that has to offset the fact that you got cash in the bank the first 2 years, right?
Yeah.
And so that's the trade-off you have to think about. It has to go down quite a bit, and even if it goes down quite a bit, you're going to get the first two payments out of ARC that have to be basically offset by really big payments in 3, 4, and 5 out of PLC.
And you have cash in the bank at the exact time you need it because 14 and 15 right now have the lowest forecasted prices.
Exactly.
That could change, but right now they have lower forecasted prices than 16, 17, and 18.
Right.
So one other point I think to make about using this tool, and I didn't do it when we were shooting these screenshots yesterday, but it is important to go in and estimate your 2014 yield as accurately as possible. I didn't do that. I just kind of used the trend yield here. But the reality is it is a revenue program.
Right.
So raising the yield in 2014 will potentially reduce the payment you'd get out of the ARC program. And so, for example, in White County, we don't know what those yields are going to be because USDA won't publish those until February. But we can do a decent job of estimating, right? And here in White County, Indiana, based on what I know about yields and the historical relationship between White County and Indiana state yields, for example, I would guess that the White County yield is probably, for 2014, is probably going to wind up closer to 195 or 200. You can plug that number in that spreadsheet, and it will recalculate the actual payments coming out of ARC under that particular yield scenario. And give you a little more accurate projection. And as you move around the country, there's going to be some counties where yields were extraordinary this year.
Right.
And that could have an impact on your 2014 payments. So that's important to look at. So I would encourage you to look at what yields are likely to be in your county on an average basis. And I guess I also have to point out that you don't want to just plug in your personal farm yields, right? Because in White County, Indiana this year, there were some folks that probably averaged 220, 230 bushel per acre. That's not going to be the county average. It won't be that high. Think about what the county average would be, not necessarily your personal farm average, okay? So let's look at the timeline. We mentioned that earlier. So last summer, you should have got a letter receiving you information about your current bases and yields. We're now in the midst of that update process through February 27, so you got the opportunity right now to update yields and reallocate bases. And that's something I'd encourage you to do. This is a good time of year to do that. The FSA office has some time, so go ahead and get that initiated and make that happen. The election process, the choosing of one of the two ARC programs or the PLC program, you could also do now, but you have to complete it no later than March 31. For a lot of people, I wouldn't really encourage you to make that choice right now. I think particularly you'll know more as time goes on with respect to what the prices for 2014 in particular are going to be. You'll have a little more information about what 2015 is likely to be after the first of the year. So I would encourage people to maybe be doing some analysis right now.
Right.
I think it's a little too soon to actually make your choice, at least from my perspective, and I think we all probably agree on that. And then next summer, perhaps a little bit like previous farm programs, there's going to be an annual enrollment process. That'll be pretty straightforward, not substantially different perhaps from what we've been acclimated to doing in the past. So the big decision points, the big deadlines to be concerned about are that February 27th to update yields and base reallocation, and then March 31 to actually make the ARC or the PLC choice. So I guess one other point that we want to make, and then we'll see if we have any questions or some additional discussion, is we have partnered with FSA here in Indiana, along with Indiana Farm Bureau, the Indiana Soybean Alliance, the Indiana Corn Marketing Council, and the Indiana State Department of Agriculture to host a series of regional Farm Bill education workshops. The first 3 of those will be next week. We're going to be in Noblesville, Indiana on Monday, Huntingburg, Indiana on Tuesday, and Shelbyville, Indiana on Wednesday. We've got 4 more of those workshops scheduled after the first of the year. So in early January, we'll be in Wabash, Indiana, Batesville, Indiana, here in West Lafayette, and then we'll also be at the Fort Wayne Farm Show on the 3rd day or the last day of the Fort Wayne Farm Show with roughly a 3-hour workshop. Each of those workshops will start at 1 o'clock in the afternoon and wrap up around 4 o'clock in the afternoon, and you'll have an opportunity to do some one-on-one questioning with us. And also FSA personnel, so you can ask some very specific questions about your operation. I think that could be pretty handy as well.
And the decision tools that we've talked about are going to be demoed there, and they're going to be working through examples, so they should get some familiarity with them, so that then they can go home and access it and do the analysis.
Exactly. We'll have a little more of an opportunity to do that than we've had here on this webinar, but so that'll be a key component of those workshops. If you're interested in those workshops, we'd ask that you simply visit our website. The registration's there. All the workshops are free. And in addition to the workshops, Indiana Farm Bureau is sponsoring a free lunch prior to the start of the workshops. They're calling that a kind of an or state policy luncheon. And they're going to talk about some of the things that are going to be in front of the Indiana legislature this coming legislative season. So both of those you can register for on our website, and the easiest way to find our website is just type in to your favorite search engine, Center for Commercial Ag, and we should pop up #1 in any of your favorite search engines.
And for those that might be watching from other states, most other states are having some type of educational programming through their extension organization, and so would check with your local county educator and find out. I know Illinois' got a number of them scheduled, and I presume that Ohio, and I know Ohio does too, but if you're in Iowa and other states, there's plenty of opportunity here to find out about the alternatives and get exposure to these decision tools so that you can actually make some individual choices.
Okay, looks like we've got some questions here, so let's see if we can tackle these. First question was, what are the marketing year average price months used in the calculations? And that varies a little bit by crop, obviously, and I'm going to do these off the top of my head because I don't have it in front of me, but I think corn starts on September 1 through the following August. Soybeans the same. And the wheat marketing year, I believe, is June 1 through May 31, if I recall correctly. And if I'm wrong on that, I'm only wrong by
And it's
30
a weighted
days.
average. It's not a simple average. It's a weighted average. And so if people sell more grain in December, January, February, that's going to have a higher weight in that calculation.
Yeah, it's an interesting process in terms of how those are computed, and it's effectively what the USDA does is survey purchasers of grain and ask for the revenue that they paid out and the bushels that they received, and they divide through and effectively come up with a price estimate. And what that means is it's not necessarily going to match up with cash market prices for a given month, for example, because that also incorporates grain that was forward contracted.
Right.
So it's representative of what farmers received for the grain. It doesn't necessarily match up if you, for example, if you took cash prices and tried to average them day by day. And that's kind of the weighted average concept that Michael was mentioning. The next question is, it was mentioned that Ark County is an election by crop. If you have corn, soybean, and wheat base for a particular FSA farm number, will a producer be electing 3 program choices for that particular FSA farm number? I think the answer is yes, right?
Yes.
Yeah.
Yep.
I don't usually get to answer questions that straightforwardly, but yeah, the answer is that's exactly right.
And the wheat choice is going to be, I think, going to be the most complicated one, because in the calculations I've done, at least in this part of the country, wheat is fairly close. PLC, when you compare PLC to Ark County, the payments are pretty similar.
Yeah, good point.
Whereas with soybeans, I think typically Ark County's better for corn
yeah.
and soybeans.
Yep.
All right, let's see. Mike stated that the highest payment potential is for corn, then for wheat. How do double crop beans play into this equation? Can you get a payment for wheat and double crop beans on the same farm in the same year? And do you know the answer? All right. We probably should refer this one to FSA. My current understanding is that double crop beans, at least in Indiana, and this question's coming from another state, but I believe they're counting those as the same as a full crop, full season soybeans when they do the computations.
That's my understanding, but that definitely needs to be checked with the local FSA office.
So that's a good question. That's
Right.
what we believe, but I think that is a good question to pose to your FSA office, and it's one that we'll pose to FSA as well. But that's my current understanding. Would Ark Individual be a good choice for river bottom farms? This one's near and dear to my heart because I grew up on a river bottom farm.
And you've thought about this.
I have thought about it, and so far I have not concluded that in fact is the case. But to be honest with you, that's something that I want to do some additional analysis on. And it is a situation, that is one of those special situations where you might want to think about it. And obviously, I think on a river bottom situation, you're thinking about the possibility of catastrophic losses and how that might impact this. So there might be an opportunity there. We've done some preliminary work on that, and at least on a preliminary basis, it didn't look attractive, but I'm not going to say conclusively that that's true. So I think you're onto something where you do, in fact, I would encourage you to do some analysis on Ark Individual on that particular situation.
And so that's where, again, that what-if spreadsheet can really, really help more concretely answer that question.
Yeah, and in that case, really probably the online tool.
The online tool has the Ark Individual, because you have to enter your individual yields.
Right.
The spreadsheet's focusing on the county, the county Ark program and PLC.
Yeah.
Okay.
Let's see. If you are choosing to go with Ark County, what is the benefit of updating your yields? Well, that's a good question. I've had a number of people ask me that. And it really isn't a benefit with respect to the payments you would get under this farm program, and I want to make that clear. But the benefit is down the road, or at least potential benefit, I guess is how I should put that. And the issue here is we get opportunities to update yields at FSA very rarely. And the odds are pretty high, but we don't know for sure, obviously, but the odds are pretty high that whatever yields you have going forward from 2014 or 2015 under this program are the yields you're probably going to have to live with for a long time. And as a result, in future farm bills, there's a potential that it would be beneficial for you to have those higher yields. But you're correct in thinking about payments under this farm bill strictly speaking, under the Ark County program, updating your yields will not impact the payments you receive. So that's true. The reason we recommended doing it is because the likelihood that it could influence future payments 5, 10, even 15 years from now.
So there's no real downside to doing this,
No.
except the work that you've got to go through
Yeah,
to do it.
yeah.
And the other issue is they do change farm programs periodically and change the way they do all of these number crunching, right? I mean, this is very much changed from previous. So you always want to have, and usually you're better off to get a higher payment when you've got more yield in the numbers, right? And so if your yields have been going up, which most farmers have, you want to also think about the base, at least now, going to the corn, because that's where it is.
And I guess the other point I'd make about the yields is that FSA is making this as straightforward as possible. They are willing to accept your crop insurance records, for example. You do self-certify, I think, when you sign up. They're not asking you to bring in scale tickets, et cetera. But you do self-certify in the sense that if there is a spot check later on, that you could, in fact, substantiate. But they're willing to use those in fact, strongly encouraging, it's not just willing, strongly encouraging you to use yields that you have recorded with your crop insurance agent with RMA. So that makes that process maybe a little less painful than it could have been otherwise.
Right.
Let's see. A couple of people have asked if this program will be recorded and available online. The answer is yes. So if you're watching this, I presume that you probably registered for the program. You should receive an email from us when this program, the recorded version, is available. And if things work well, as we hope, it should be out online on YouTube by about 5 o'clock this afternoon, or maybe a little bit sooner than that. So you'll get an email from us with the link. That's one way to find it. The other way to find it is it'll be on the Purdue Extension YouTube channel, and you can search on there for, we have a playlist called for the Center for Commercial Agriculture, and it will be on that playlist. And so that would be an easy way to find it as well, but we'll also email you the link. Let's see. Is the PLC payment yield number the updated FSA or current corn yield number? If not, where do you find this yield for corn, soybeans, or wheat? So the PLC payment yield in the online tool and in the spreadsheet that we demoed, they've got a default value in there. So the updated yield number that I was suggesting you put in would be, if you're updating your yields, you've got that data. That's coming off of your farm. The easiest way to come up with the correct number would be to use the online yield update calculator that we pointed to. We didn't actually show you how it works, but it's very simple. And that would give you the updated number for every individual farm. So we're assuming that you've got the data for your own farm, and that's what we're suggesting that you would put in, and that would give you the most accurate projection of your PLC payments. Let's see, is the marketing year average price already determined for 2014? And the answer is no. That will carry out all the way through the end of the summer. So USDA will continue to collect data for not only here the rest of 14, but also through 15 until the marketing year for the 14 crop ends. And so marketing year average really is about, the marketing years start ostensibly with the beginning of harvest, or at least match up pretty closely with the beginning of harvest, and then continue to collect revenues and bushels to compute monthly prices, weighted monthly prices, all the way through the marketing season for that crop. So for the crop that was harvested here in the fall of 14, that marketing year extends until the 2015 harvest begins, so it goes all the way through August. So, however, we have a lot of information about 2014 already because it's a weighted average, and the biggest portion of the crop is marketed in the first few months. So once you have data, particularly the first month or so of 2015, you've got a pretty good idea of what the marketing year average for 14 is going to be. So you still have to forecast it, but you can forecast it with a pretty good degree of accuracy.
But USDA comes up in the WASDA report comes up with a monthly estimate of what they think the 2014 price is going to be, and also FAPRI is updating their forecast every month.
Right.
And so if you use the online tool, you'll see that they're updating that information frequently.
Okay, we have a question about strategy for reallocating base acres. Should we reallocate base acres to maximize corn and wheat and minimize beans? The answer is in Indiana, in the Corn Belt, the answer is yes. That is what we're recommending. In individual situations, particularly as you get outside the heart of the Corn Belt, you're going to want to think a little bit about the wheat versus corn, is how I'd characterize that. But when we look at the potential payments here in the heart of the Corn Belt, Indiana, Illinois, Iowa, and surrounding states, it would favor reallocating base towards corn over wheat. Now, as you get farther away and in environments where wheat is a more competitive crop on a year-in, year-out basis, you're going to want to think more about the wheat side. So it's a case where it depends on your location, and it's something you need to look at a little bit. Let's see. There is a question about payment caps. There is a per-person cap on payments, correct? And then this individual poses it at $125 for a single or $250 married filing jointly. It's actually not tied directly to the tax return. It's tied to entities. So the payment limit, and correct me if I'm wrong here, but is $125,000 per entity. And many farming operations are structured in a way that they are comprised of several entities. But it is true that there is a payment limit. And if you look at those dollar amounts, depending on how you're structured, there's going to be some people that hit those payment caps. In many cases, those are farming operations that would have hit payment caps under previous farm programs. And as a result, they're probably structured in a way to minimize hitting those caps. But there's definitely going to be some people that hit some caps. And I guess I'll make one point related to that, and that is in some situations, that might be an incentive to restructure some rental arrangements towards share agreements and perhaps away from cash rent. That would be a way of perhaps minimizing the probability of hitting those payment caps. So that's at least one strategy to think about. So. Well, I think that wraps it up for questions. Those are some great questions. I'm sure we didn't answer all the questions. There's lots of questions, and so a couple of ways to deal with that. One, obviously, I would encourage you to think about attending one of our regional workshops. Those are coming up here next week and then again in January, and that's a great opportunity. And those are all large venues, so we've got a lot of capacity for people to attend. So I'd encourage you to do that. And one of the great things about that is we're going to have a large enough staff at those, both Purdue Econ as well as FSA, Indiana FSA, that we'll be able to answer some questions individually after the program. And I know people have a lot of individual, personal kind of questions that they might not want to ask in front of the entire audience. So that opportunity will exist. That'll be a nice thing about those programs. In addition to that, Purdue Extension is partnering with local FSA offices on a lot of multi-county meetings and in some cases single county meetings around the state. So those will be taking place as well. Several of us will be speaking at some of those. Our Purdue Extension staff, educators will be speaking at a lot of those, and we've gone through these tools in some detail with a number of the educators. So lots of opportunities for education about this, and the good thing about this is we're early in the decision-making process. We've got time. This is a good time to be doing this kind of stuff now that harvest is largely over here in Indiana.
Yeah, and at the same time, don't wait until the day or two before the deadline. I mean, don't put it off so long that you don't have a chance to kind of do the thinking and do the analysis. And so sometimes those deadlines being out there, further out there, we have a tendency to say, well, I'll get to that after I've got everything else done. Don't do that.
And I guess that's a good point. One of the things you ought to be doing is contacting your FSA office to make some appointments, right? I think they would much appreciate that. One of the concerns I know is going to be as those deadlines approach, there won't be enough hours. There won't be enough hours in the day to satisfy everybody. So it is important to make some appointments and make some deadlines for yourself with respect to making decisions prior to the actual deadlines here. So.
And the 2014 county yields will be available in February. That's the typical time frame for that. And so if you want to plug in the 2014 county yield, you'll have to wait till then.
All right. Well, with that, we're going to wrap up our webinar today. We thank you for joining us. We appreciate the opportunity to visit with you. I do want to point out we do have a lot of information on our website. So if you come to the Center for Commercial Agriculture's website, There's a program option button there near the top of the screen. That'll take you to where we offer a lot of educational information on various topics, and you'll have a chance then to click on a button that says Farm Policy. And one of the things we've done, one of our colleagues, Roman Keeney, with some help from several other faculty members, has written a series of fact sheets. They're fairly short, fairly concise, but very accurate. I would encourage you to maybe take a look at those. You can download those. Those are available as a PDF, I believe, and so grab those, read through them. That'll give you some more information to kind of backstop the information we covered today. This webinar will be available as a YouTube, hopefully by the end of the day. And then we'll also make the slides that we used available on our website as well. So you'll have the opportunity to download those and read through those a little more carefully.
And Jim, we're continuing to have, this is actually part of not only the Farm Bill discussion, farm policy discussion, but we're also having continuing webinars on managing in this economic downturn type of thing. So we have those that'll be upcoming over the next couple of months as well. Is that correct?
Exactly, and the next one of those is scheduled for 2 weeks from yesterday. It'll be on the 18th of December in the same time slot. We typically offer our webinars there at 9 a.m. Eastern. So that information will be available on our website soon. It's not out there at the moment, but it will be out there pretty soon. So, and that one will focus a little bit more on a combination of things, but it's going to look a little bit more at some longer-term outlook, and then start talking about some strategies that you can use to manage your way through this downturn that we're engaged in production agriculture.
Yep.
So with that, on behalf of my colleagues and on behalf of Purdue Extension and the Center for Commercial Agriculture, I want to thank you for joining us and wish you a good day and certainly a good holiday season. Thank you.